Good morning, everybody, and welcome to the session. My name is Joe. I will be your host with Money Show. We're happy to have you. A couple of bits of housekeeping. We'll get right into the presentation. First and foremost, Happy New Year to everybody. We appreciate you. We want to thank you all. Last year was a record for us producing these virtual shows and back to live events as well. We appreciate you. We appreciate folks like Avi, who is sharing his insights with us, and he's here to kick us off this morning. So thank you all for coming. There is a live Q&A at the end of Avi's session. There is a chat box, whether you're watching us on a mobile device or a desktop. There is a live interactive chat. We will answer questions. So get those questions over to us, and time permitting, we'll get to as many as we possibly can at the end of Avi's session. With that said, it is my great pleasure to introduce to everybody Avi Gilbert. He is the founder of ElliottWaveTrader.net. Avi Gilbert is an Elliott Wave market analyst and author of ElliottWaveTrader.net, which is a live trading room featuring analysis by him and a dynamic community of professional traders. Mr. Gilbert's Elliott Wave analysis appears frequently on such sites as TheStreet.com, MarketWatch, Forbes, and Seeking Alpha. It's my great pleasure to introduce to everybody Avi Gilbert. Avi, the floor is yours, sir, and I'm going to stop sharing my screen so you can start sharing yours. Thank you again.
Okay, let's see. Are we good?
You are good, sir. Good to go.
Well, thank you everybody for joining us this morning. As Joe said, I am Avi Gilbert, and I am what they call an Elliottician. Well, what the heck does that mean? Well, back in the late 1930s into the early 1940s, there was a gentleman named Ralph Nelson Elliott who did some significant research into the markets after the Great Depression. After the 29 market crash, because it made him very curious what would cause such a crash in that manner when everybody was so bullish at the time right before the crash. So he started doing a significant amount of analysis about markets, and he discovered something. He discovered that markets are fractal in nature. What that means is markets are variably self-similar at all degrees of trend. And so he then took that into something that we now use as Elliott Wave analysis into a very workable mode. What Elliott Wave analysis explains to us is that the market moves in 5 waves during the trend. The trend itself is a 5-wave move, and a counter trend is a 3-wave move. Now, within waves 1, 3, and 5, those move with the trend. Waves 2 and 4 are the counter trends. If we look at this larger degree, and by the way, also waves 1, 3, and 5 themselves are comprised of 5 waves each. So as you start going deeper and deeper and deeper down in time frames, you'll start seeing, 5 waves, 5 waves, 5 waves. Everything has to match throughout the entire pattern, and we'll go through it and I'll explain it a little bit more for those that are just starting to hear about Elliott Wave analysis. So let me work with a very large degree trend, and I'll show you what I mean from this. And I'll also I'll begin to show you my expectations in the bigger time frames. Back here, if you come back to the 1929 bottom left of the chart that I'm showing you, there's a little wave 1, a Roman numeral wave 1 in parenthesis, right before the crash of 29. And this entire structure is based upon that rally followed by the 29 crash. We start our large degree count from that, where we view the rally into the high of the 29 crash as wave 1 of a very larger degree trend. And the crash of 29 is what began wave 2 and completed about a year or so later. I think it ended, about 30 or 30, maybe 2 years later, about 30, 31. And that kicked off what they say is the Great Depression. Now, if you look at this structure in here, it was at about 1941 that Elliott made the most incredible market call I have ever come across in history, in anything that I know about market history. In 1941, as the as World War II was raging around him, Elliott predicted that we were about to embark on a 70-year plus bull market. I know, I mean, when I first read that, I was just shocked. A 70-year plus bull market while World War II is put yourself in that mindset. The entire world is now ablaze in World War II. And this guy is predicting a 70-year bull market that's about to begin. Well, as we can see, I think Elliott pretty much nailed it. Now, we're now going to build our analysis on the shoulders of Ralph Nelson Elliott. So whereas the pullback into the Great Depression, into the 30s, was wave 2, we're now building our entire structure off of that 1-2. Now, before I go any further, I want to show you what we all can count to 5, hopefully. So, you know, I'm going to start with 1-2 here in the paren 1-2 in the Roman numerals, and I'm going to take you all the way up to where I think wave 3 is going to top, and that is at the top of our chart. And we are now approaching that wave 3 top. Now, as you could see, that was a massive third wave that which is what Elliott was predicting. Now, I will tell you, third waves are usually the strongest segment of the 5-wave structure. A third wave rally is, or even a third wave decline, is usually the strongest segment of a 5-wave structure. In commodities, it's usually the 5th wave is the strongest segment of that 5-wave structure. But in equities, it is most often the third wave is the strongest rally structure during that 5-wave structure. And as you could see, when you take a very zoomed out perspective of this, you can see this was a very strong rally that pretty much was just going straight up throughout the last 80 years or so. Now, if you also take a look, after we got the wave 2 bottom, around when the Great Depression began, you see we have another 1-2, and that follows up to 3, which was the 2000 tech bubble. And that further breaks down into 5 waves. So as you could see, if you look through this structure, you'll see each wave degree breaks down, each wave degree within the trend, waves 1 and 3 and 5 will break down into 5 wave structures. And you'll see that if you look at this chart very carefully. But once we topped in the tech bubble, we then had a very sideways market action that took us about 9 years, eight and a half, a little over 8 years, actually, because we bottomed in March of 2009. And that sideways structure was a wave 4 structure within this higher degree wave 3 that I think we'll be topping out within the next couple of years. Now, if this wave 3 structure was 8.5 years, keep that in mind, because I'm now going to explain what I think is going to happen in the next higher degree 4th wave that I'm expecting. So as I said, I think everybody can count to 5. I'm assuming you can count to 5 if you've made it this far in life. So once we top out in this larger degree wave 3, which began after the Great Depression, we are, my expectation is we're going to get a larger degree wave 4. And that wave 4, and remember I said that the wave 2 here only took a couple of years. Elliott told us that there is a theory of alternation. That means that if wave 2 was a very sharp and fast pullback, wave 4 will likely be a long and grinding event. So whereas wave 2 only took us 2, maybe 3 years, I think wave 4 is going to be a very, very long bear market, similar to what I think we've recently seen in Japan over 20 years. The other thing that I'm looking at is we know that the one wave lower, which was the 4th wave that took us from 2000 to 2009, was a little over 8 years. My expectation is it should be significantly bigger than that wave degree, one lesser wave degree. So because we're going into a larger wave degree of a 4, my expectation is it could take much longer, potentially as long as 20 years, similar to what we've seen in Japan. So we're going to start moving into this chart a little more in depth. I'm going to put this away for now, and I'm going to open up my charts, and we're going to start with my monthly chart just to give you some idea. This wave 4 that concluded in March of 2009 is relative to this wave 4 that I have here. So of course, once we finish a wave 4, we move into a wave 5, 4, 5, and this is that big 3 that I had on that chart that I think was topping. And if you look to the bottom right of the chart, you will see my large degree wave 4. So as you can see from this chart, guys, I'm looking for a very long-term bear market. It's not anything we've yet experienced in our lifetime. In fact, the pain that's felt during one of these types of bear markets would be akin to what you would see during the Great Depression, because the equity correction degree that I'm looking at is the same degree. This 4th wave that I'm looking for here is the same wave degree as the 29 market crash, which led into the Great Depression. So dare I say we could experience the greater depression. And I will tell you, I genuinely pray that I'm wrong in my assessment. But the market has been following this structure so well over so many years that it scares me to actually say the things that I actually believe we're going to see from this chart. And like I say, I pray every day that what I think is going to happen will be avoided. I fear that that's not going to be the case. But I will tell you, there is one way that I can foresee us not moving into a 20-year market correction. Rather, maybe we only get a 7 to 10-year market correction. One way or another, I think the high probability expectation is once we finish the rest of this structure over the next couple of years, I'm expecting a large pullback. The more bullish, most bullish case scenario that I can foresee at this time is only getting a single 3-wave pullback. If you notice, I have an Alt 1 at the top of my chart here. And that Alt 1 is referenced to that Alt 2. In Elliott wave analysis, we have a primary count and we have an alternative count. Why do we do that? Well, when a general goes to battle, that general will put together his regular battle plan, but he will also have a contingency plan in case something doesn't go according to his primary plan. We do the same thing in Elliott wave analysis. And the reason we do it is so that we do not lose money. If we lose money, we can course correct very, very quickly. It does not take us long to recognize that our primary analysis was wrong, and we are able to course correct rather quickly. So at a minimum, I will tell you, once we finish this 5-wave structure, I'm expecting at least this ABC over the coming, guesstimating maybe 7 to 10 years once this completes. And once that completes, one way or another, when you get an ABC down in the market, it's an opportunity to start looking long again. So one way or another, this will likely be a long entry for those that are following me at the time when we get there. The question is, will this rally be a corrective rally that will then resolve in which will probably be a major market crash, the largest market crash we've probably seen in history? Or will this be a 5-wave structure that will only get a corrective pullback, and then we're off to the races in a multi-decade bull market? The resolution will not come for some time. But in the meantime, what I'm looking for minimally is a sizable market correction that is probably going to take us back down to the 1800 to the 2200 region from the 6000 region, which is my target as we're looking right now. Now, let me take this chart apart a little bit so you can have a little understanding of how I'm looking at this. If you notice this big spike down, yes, that was March of 2020. Many people ask, how do you know that, how did you know at the time that 2200 would likely be the bottom of that and to expect another rally to 4,000 plus? Well, when I look at where wave three, this wave three off of here, top 1, 2, and all of this, you see all the structure filling into this wave three, we have a really good idea as to where retracements occur for each of the wave structures. Wave 4 retracements typically take us back down to 0.382 of the wave 3 rally. Guess what 0.382 of the wave 3 rally was? Yes, you guessed it, 2,200. The market bottomed at 20, spiked down at 2,200 to 2,187. And then what happened? We were off to the races. That is how I came up with that 2,200 number. And as we were moving into that region, we were also completing a C wave. So there were a number of things that were telling me at the time to expect a massive rally off those lows. People have called that market called chart magic or what have you. It really is simple math. And the reason that the market follows this type of math is because what Elliott discovered was the markets are generally patterned. Why are they generally patterned? Because you and me, you and I are what really determine how the market runs. It's mass sentiment that governs the market. It is not the Fed. It is not economics. It is mass sentiment. Human interaction is what governs the markets. And I know up until today, everybody believes in the efficient market hypothesis and all these other reasons that they believe the market runs. If you start looking at some of the recent studies that have been conducted about the stock market, you will see that more and more people are moving towards an understanding of the behavioral aspects of the market. That is what is truly directing the market. In other words, when the market is too euphoric, when too many people are bullish the market, what happens? You get a top. When markets are too bearish, when everybody that's wanted to sell has sold, what happens? You get a bottom. And the Fed cannot stop this one way or another. There's a chart that I love using. I'm going to bring it up. There's a chart that I bring up quite often, and my guys really get a chuckle about this. If you go back to March of 2020, look what the Fed tried to do. The Fed tried to stop us multiple times from continuing the crash. The market was heading towards 2,200 S&P, no matter what the Fed did. So the Fed tried and tried and tried and just couldn't stop us. And when the market finally bottomed at the target of 2,200 and started rallying strongly, what did everybody say? Oh, must have been the Fed. Well, I'll tell you, when the Fed tries 4 times and it only took till the 4th time for the market to bottom, there's an old story I tell about my kids. We used to drive, and when we would stop at a light, they would look at the light when it was red, and each one of them would take a turn and say, now. Another one would say, now. The next one, a couple seconds, would say, now. They were trying to time the market, the light changing, and to claim that the Fed is what caused the bottom of the market at that March low is no different than what my children were doing with the now, because the Fed tried 3 times before then. That was each of their nows. And you know what? Ultimately, they tried a 4th time, and it was within the timing of the bottom that we struck. And guess what? The market hit the exact target we were looking for and rallied. If you go back and you actually read Alan Greenspan has said himself, no matter what the Fed does, they won't be able to prevent market crashes, market corrections, no matter what they do. He said market bottoms when the bearishness subsides. In other words, when you've hit an extreme in bearishness, and then the bearishness can subside and we can turn the other way. That is exactly what happens at every single market bottom in history. Every single market bottom in history. So in the meantime, I'm looking for the market to continue higher. Now, I'm going to take you back a little bit, and I'm going to show you, I'm going to look at the daily chart just to give you a little peek as to what I'm expecting. If you've been reading any of my work recently, you know I am expecting a top for this degree to resolve in a pullback of this degree, which will then set us up for the rest of 2022, folks, for a sizable rally. My next ideal target is 5,500. Minimally, I think we get to 5,160 from here. I really think we're going to 5,500, which will take us into the end of this year, potentially into 2023 before that actually completes. I'm going to show you something on the smaller degree. And I think this is going to give you a better perspective. And I'd like to finish over the next 8-9 minutes and then take questions for at least 10 minutes. This will give you a better perspective of what I'm looking at right now. I'm going to actually go back 1 second. The last time I did a money show this is where we were the last time I did the money show. And I said to you guys at the time, my expectation is I think we can resolve lower one more time. And I'm looking for an ideal target of 4270. Now, we've developed something called Fibonacci pinball. And Fibonacci pinball gives us some tremendously accurate targets on the upside and the downside. And my expectation at the time was, I said, look, we have a major market pivot below us. We remain very, very bullish. And I'm still looking for 5,500 to 6,000 over the next couple of years. And this is what I was saying at the time, as long as this market pivot holds on this pullback. And my ideal target was right here, 4270. Now, as we know now, this is what the market did at the time. This was the B wave that I had on that chart. The market pulled back to exactly where? Yes, it came right down to 4270. And on that chart, I said from 4270, I'm looking for a rally towards 4,900 from there. Again, all of this is based upon the math and our Fibonacci pinball structure. We then have to resolve how the market is developing within that structure. But you know, when you are able to look at the market from a fractal standpoint, understanding that the structures are variably self-similar at all degrees of trend, it gives you great targeting point for pullbacks as well as targets on the upside. So we hit the 4270. I was looking for about the 4,900 region for the top of this rally. Now, the problem that we've been seeing over the last couple of months is we're getting a lot of volatility. And what to me this looks like is primarily, to me, it's looking like an ending diagonal, which usually gives you this type of up-down volatility. The hallmark of an ending diagonal is that the last rally of the ending diagonal usually is a very strong move through the trend line, making you feel like this is going to break out forever. It then abruptly stops, turns down, breaks back down below the trend line, and then drops very, very quickly to the point at which it originated, or the general region from which it originated. So in my primary expectation over the next couple of weeks, as long as we hold the low we struck this week, I think we're going to get that fifth wave to complete this ending diagonal. Should we break down below that low, then I think we're going to head down to the target region I have for that fourth wave. I'm going to go back to the 60-minute chart for a second. I'm sorry, the daily chart to show you. Again, I think we're topping out in this third wave if we haven't already. And I think we're going to get a pullback towards our market pivot, but I don't think we're going to get quite that low yet. As you can see, we tested the market pivot on that wave 4, the one lesser degree wave 4 that we were looking at back at in the last quarter of last year, we came right to the top of the market pivot and we began the next rally. We may approach the market pivot again on this degree wave 4, but at that point in time, I think we're going to be heading up to 5,500, pull back to 4,600, and then we'll have our final rally in 2023, maybe 2024, that will take us up to the 6,000 region. This is how I see this resolving before a large degree bear market begins. So I still think you have some time, and I think you're going to have a wonderful buying opportunity over the next couple of months in this degree wave 4. Again, I'll show you this. Depending on when we break down below here, the wave 4 target is here. Like I said, maybe we extend down to the prior 4th wave as well. Maybe we get as deep as 4,300. Right now, that is not my expectation. My expectation, depending on when we break down, if we get up to here, my expectation is about 4,440 to 4,485. If we break down earlier, 4,350 to maybe 4,300, 4,400. Again, outside shot, we may drop as deep as 4,300. But overall, as long as this region holds on the next pullback, folks, this pullback is going to be targeting our next higher target, 5,500 on the S&P 500 into the end of this year, potentially early next. So in general, that is my overall expectation in the market over the next few months to the end of 2022 into 2023-24. And then beyond 24. That is the general perspective that I have. Nothing has changed. The market is still following through. I can't say perfectly, but I would say almost perfectly. And remember, there's no such thing as perfection in the market. We are guided by math, and whereas the math tells us where we're right, where we're wrong. For now, the math is telling us this pattern that we have been tracking for years is still has a bit more to go before we finally encounter a bear market. But what I will tell you, and I can almost assure you of this, because the decline that we're getting right now, this last decline we got over the last few days, the amount of bearishness that I am seeing out in publications now is astounding. Can you imagine what it's going to be like if we get back down to the 4,400 region on the S&P? So I want you all to prepare for that. It is likely that we're going to see that type of bear market chatter. You're going to hear a lot of bear market chatter, but I'm telling you, it is going to be a wonderful buying opportunity for a rally to 5,500 based upon everything we've been seeing all these years. So I would be glad to open up the floor to questions now.
Avi, thank you very much for your insights. We have a great crowd in here today, folks. We have a lot of questions, so we'll get to as many as we can. Malcolm's
if
asking,
I may also, if I
Go
may,
ahead.
can we keep questions just to the S&P 500? Because I know I'm going to get a lot of questions about gold and everything else under the sun about various stocks. Let's try to keep it to the S&P 500. Maybe I'll take a bond question, but generally let's try to keep it because we're short on time.
Understood. Doug's asking, I'm sorry, Lewis is asking, let's see. I'm sorry, Doug, we didn't quite make the S&P 4,900. Does that affect your targets of 5,500 and 6,000?
Great question. The answer is no. Basically, this will give you a little bit of our understanding of fib pinball so you can understand. This degree wave 3 is the wave 3 within this wave 3. In our larger degree pinball structure, this degree wave 3 usually targets between the 1.0 to the 1.236 extension. So my upper end expectation really was 4960 for this degree wave 3, but usually it targets anywhere within this region. I still think we have one more push higher because there are smaller degree targets, there are smaller degree calculations that point to the 4860 to 4882 region as a potential top, but we have come into the general target area that I would expect for this degree wave 3, and to begin to start looking for this degree wave 4. That does not change my target for this degree wave 5 of 3.
Thank you. I'm going to read this question from Brad, just as he wrote it. Mr. Gilbert, I'm a subscriber to your service. Excellent. Sorry, one second. Apologies for that. He says, great service, a great team, excellent commentary. My question is, please, you've been very clear in your, sorry about that, Avi, one second. It says you've been very clear in your bearish stance, and if and when the S&P hits 6,000, you make a very strong case grounded in economic history and technical analysis as to why the markets move materially lower. As this move lower occurs, what governmental and policy responses could be enacted which would negate or cushion the forecasted move lower? And he says, thank you.
This is where I try to explain before, folks. We as a whole are unable to change the manner in which a market moves in general. We've had many type of entities that have tried. We've had the Fed that has tried. We've had the US government that has tried. If anybody was around during 2008, you remember one thing after another that the government tried was ineffective until the market actually exhausted itself at the bottom. Unfortunately, and I will tell you, my theory is not coming out of left field here. I will tell you that smarter minds than mine have agreed with this perspective, such as, like I said, Alan Greenspan is one that has put forth this perspective. Behavioral studies that have been conducted over the last 20, 30 years have come to this perspective. Exogenous factors to the market are not as anywhere nearly as important or as directive as many people believe they are. So whereas the government, the Fed, whomever is going to attempt to pull us out of it will ultimately be unsuccessful until the market actually begins to bottom on its own. And I showed you that back in March of 2020. I have on this long-term chart a few things that these are just pure guesstimates, folks. You know, whereas once we get to the bottom of the first A wave in this first ABC pullback, you know, I said maybe the Fed starts buying ETFs and then we begin to rally. Why? Because, you know, I think it'll just fold into time. Of course, there's going to be a lot of things the Fed's going to try on the way down, and I think it will be completely unsuccessful. But what we may see is at the bottom of this A wave, the Fed may try to start buying ETFs, and then we're going to get our corrective rally, and then we'll get a market crash. And then, of course, the Fed's going to be ineffective during this crash, and maybe at the bottom they'll start saying maybe we're going to start buying some stocks. But ultimately, I will tell you this, if we get the full extent of the bear market that I expect, and the Fed will have proven, just as the Bank of Japan had proven itself incapable of stopping a 20-year bear market, if the Fed will be proven to show that it cannot, and unfortunately that's what's going to happen if we get this 20-year bear market, they will be unable to stop this. You're going to hear a lot of calls for folding the Fed. It's just a general expectation. I am not a prophet. I cannot see into the future. I can't tell you what news event, what is going to happen in the economy. I can't tell you what's going to happen from a news perspective. I can give you a general path that I'm foreseeing for the market, which generally has been extraordinarily accurate over many, many years, because that's what the market is telling us. What people will ascribe to, you know, what news they'll say causes this and that, you know, I'll leave that to all the pundits. My concern is I want to know where the market's going. You can choose, everybody else can choose to identify what the news will be. I don't care. All I want to know is where's the market going. So that's the long and short of the answer.
Thank you. You hit a lot of answers on that question. So thank you. Andrew's asking, since the March 2020 bottom, does the lower momentum of your third wave relative to the first wave concern you at all?
That's give me that question again. I'm not sure I understood it.
He's asking, 1 second. Sorry, we've got a lot of questions, and since the March 2020 bottom, does the lower momentum of your third wave relative to the first wave concern you? Did he get that right?
I'm not so sure I'm seeing lower momentum, so I'm not sure we're dealing with the same facts.
That's fine. Andrew, if you want to rephrase, and I'll try to read it again. Chris is asking, thoughts on how long we stay down at 44.50-ish on a sell-off? The last year, the declines have been only 4 to 5 days. Should this one last longer and give one more time to buy the lows, in your opinion?
Great question. What I will tell you is, again, what I said about the theory of alternation or just relative perspectives on the market. The first and the second waves that we've experienced until we've gotten up to this point have been very, very, very short. For that reason, I think it's reasonable to expect a longer fourth wave. And whereas the fourth wave of one lesser degree here, or even this fourth wave, each one took, this one took about a month or so. This one also took about a month or so. My expectation is I think it's reasonable to expect that it could take a couple of months before it completes. I think it's reasonable.
Thank you. Quick question from Joe. Trying to keep it in what you're asking for. Are you still concerned about the banking system? In a previous presentation, you were going to give a list of 15 strong banks to deposit your money. Any thoughts on the bank system? I know we try to keep it in the S&P, but this question has been asked a couple of times.
I will tell you guys to do this on your own. I'm going to give you a homework assignment. I want you to now compare what the stock market has done from the 2009 low. Take a look at a stock chart. Stock market from the 2009 low, and compare that to the Citibank rally from its 2009 low, and compare both where both are relative to their 2007 tops. If you want to see what a sick chart looks like, Citibank is your chart. And I will tell you, there are many banking charts that not quite as bad as Citibank, but there are many banking charts that look the same. And my view is that I think we're going to see a number of banks, and I know this is going to sound controversial, but I think you're going to see a number of banks that you thought were untouchable potentially go out of business. Now, will they actually go all the way out of business? The answer is I don't think so. I think a number of the banking leadership is smart enough to see what has been going on in the world, and they will probably take Cyprus as their example. What occurred in Cyprus was something called bail-ins. In America, we had bailouts from the government. I don't think the society is going, as a whole, is going to be comfortable anymore with bailouts of big banks. I think what you're going to see is bail-ins. What is a bail-in? Well, what the bank does in a reorganization of that kind is they will then convert deposits and their own depositor money into equity, providing for more liquidity for the bank to survive. And it means that if you're a depositor in a bank that's going to go under, you will find yourself one day, let's say you have $1 million in the bank on day one. Well, after that bank has a problem, that $1 million may be cut down to $500,000 or even $250,000. And you now find yourself as one of the owners of this bank under the reorganization using your money. And these bail-ins are usually forced. And that's what happened in Cyprus. Now, not long after what happened in Cyprus, guess who started taking retail money for their banks? And you're going to love this one. Goldman Sachs. I mean, I wrote at the time that this is what I saw in Goldman Sachs starting to take retail deposit money. They're trying to set themselves up for the possibility that they may have to deal with a bail-in. For the first time, Goldman Sachs started taking public depositor money. So folks, you were asking me about the banks. I'm telling you that I think we're probably going to be coming. Initially, I thought we would have our list ready by by January of 2022. It looks like we're probably not going to roll that out by February of 2022. But we're coming out with a list of 15 of some of the strongest banks that we have found across the country. From a liquidity standpoint, a capitalization standpoint, we've used many, many different factors to come up with our list. And it took us a little longer because not all the banks that we were looking at, that we thought were among the top banks, passed the tests that we were putting them through. So yes, I'm expecting when you go into what could be the Greater Depression, yes, I'm expecting a banking problem as well. And look, I pray I'm wrong. So, and if I'm wrong, what's the worst that you're going to have? You put your money in these banks and they're safe, just like they are in any bank. You're not going to lose anything, because these are going to be the safest banks anyway. I intend to put my money there as well. So that's my spiel about banking.
Terrific. We're up against the clock, but I have one other question. Folks, there's a lot of questions here. We're going to give you a way to get in touch with Avi directly because a lot of people have asked. Last question, Benji's asking, just curious, Avi, your SPX bullishness diverges from another EW guru, Robert Prechter. How can two gurus be on two separate mountains? Respectfully.
I'm going to start by saying I just had lunch with Bob not long, about 2 months ago. I have the absolute utmost respect for Bob Prechter. I think what he has done for market analysis, it has been unmatched. And I personally owe a lot to Bob from what I have learned from him. However, Bob, I think, he had his fundamental perspective of markets cloud his objective reading of the charts. So, and I think, unfortunately, and it's actually sad for me to see how he's been wrong about calling top after top. We developed something that Elliott Wave International did not have. It's something I saw early in my Elliott Wave training on my own. And it's something I just picked up to the market, and I now call it Fibonacci pinball. And whereas most people look at Elliott Wave and say it's too damn subjective, and I saw what they meant. I found this what we call Fibonacci pinball. It is a box. It's an objective box around which we present our Elliott Wave analysis. And if the market diverges from that box, from that objective Fibonacci pinball box, then it objectively tells us that we're wrong. And it tells us early. It doesn't wait for till you have a significant amount of losses. It tells us early on that we're wrong. So we utilize a much more objective method and standard when we apply our Elliott Wave analysis. And within that, it tells us when we're wrong. It tells us when we're still on the right track. I think that probably is the biggest difference.
Avi, thank you very, very much for your insights. We had a great crowd, a lot of questions. Avi, how can folks get with you and your research directly? Do you want to give them an email address or a way to contact you and the team? Because a lot of folks have asked.
Sure, guys. We offer a free trial, a 14-day free trial at ElliottWaveTrader.net. That's ElliottWaveTrader.net, 2 L's, 2 T's. ElliottWaveTrader.net. We offer a 2-week free trial. We have a significant amount of material from which you can learn how we do our analysis. And our goal, honestly, is to teach what we do. I have no problems teaching what I do. And we now have almost 8,000 members and almost 1,000 money managers. And we teach everybody what we do. And you know what? We are so glad when we hear how well people are doing with us. It really is what keeps us doing this. So you guys want to come in, you want to learn, you can ask questions. We have chat rooms. We have 20 some odd analysts. Feel free to come in and ask all the questions you want, but you have to come in with an open mind to learn because we are willing to teach.
Avi, thank you. And folks, listen, obviously, Avi won't say this, but I will objectively. Avi's work should be part of your process at the very least, if you're serious about investing. And he definitely educates and he proves that by filling these rooms. Thousands of people come and watch him at these presentations. So Avi, we are grateful to you from Money Show for your insights, kicking us off on this first virtual event for the year. We appreciate you, sir. We always do, and we look forward to working with you more throughout 2022. I want to thank you for doing your presentation. I want to thank everybody who's joined us at this virtual expo and all the past ones. And keep in mind, we're back live in February, the 24th to the 26th, live, the Money Show Traders Expo in Las Vegas. So come out, stretch your legs, meet some of us face to face. We look forward to seeing you. But again, Avi, thank you, sir, for kicking us off on this session. And folks, if you can find Avi on moneyshow.com as an expert, and all his past presentations are available there for you to purchase as well. So with that said, Avi, thank you again, my friend. We wish you a good day and a good new year. We'll talk to you soon. And folks, thank you, everybody, and enjoy the next session and the rest of the week. Thanks again,
so
folks.
much for having me.
Thank you, Avi. Be well, everybody. Bye now.